Welcome. My name is Sasha Moore, and I am here with Andrew McVeigh, who is the managing partner of the investment management business Remara. Welcome.
Thank you, Sasha.
So, what I'd like to chat to you about today is really Remara's approach to private credit and how you've structured the private income fund.
Yep, certainly. So we've got a vertically integrated model around private credit. So what that in essence means is we look to own the originating assets and the originating businesses. So the businesses that lend directly to the consumer, we've got an equity stake in, we've got ownership, we've put capital into, and that allows us the ability to be able to manage the types of loans that they originate, macro and micro kind of credit impacts. It allows us to essentially be aligned with ultimate investors because we're placing first loss capital into each of the warehouse trusts. And more importantly, it means that we've got better flexibility in terms of the pool of assets we manage and at the point of origination, the credit standards we use, and also how we respond to market dislocations. So whether that's credit dislocations or liquidity dislocations. I think the best example we can give on that is pre-COVID and then moving into COVID. So, through that pre-COVID period, we actually changed our credit standards to move away from retail-based businesses, gyms, and also beauticians and those types. So what is traditionally seen as highly discretionary spending. And that did a tremendous job in terms of insulating us from the COVID hardship program because a lot of the businesses that suffered through that COVID period were retail-based and discretionary-based businesses that couldn't operate through lockdowns, etc. So we were able to make that call pretty quickly, and we did that at the start of 2020 before COVID occurred, based on exposures that we'd seen in our book and underlying credit standards that we'd kind of seen slowly start to degrade. And as a result of that, we were able to largely sidestep the COVID lockdown and hardship period in terms of credit losses, but also arrears, etc. on the book. So that's probably the biggest benefit that we get through that vertical integration. We can manage the credit standards, what we originate, where we originate it from, and can look at kind of micro trends that are happening within certain industries, certain asset types, exposures, etc., and be able to manage that kind of on the fly. The further benefit is the alignment of interest in terms of us having ownership stake in that originator essentially means that if there's losses at that originator level, that originator wears that first before fund investors. So at any point in time, we are losing our capital and we're suffering losses before fund investors do. And what that does is it hones the focus, right?
Yeah.
And for us, we see that as a very big benefit that investors receive. And it's largely without peer with a lot of other private credit managers in Australia who will not have that same ownership stake and will rely on third parties and buying instruments and notes and packaging those up, but have very little control over the credit and have very little economic interest in the underlying loans outside of management fees, etc., etc.
Less skin in the game.
Exactly. And from a credit perspective, that's always vitally important.
Yeah. And in terms of, you just raised, the market conditions, what do you feel is the investment appetite for this type of fund structure at the moment?
Yeah, look, it's a really good question. I think, the trouble that we've had is we've had a declining interest rate environment and we've moved into a rapidly inclining interest rate environment, and that creates a lot of challenges. So private credit and the fund that we offer gives people a floating rate return. As I said, it's diversified across a number of different credit assets and underlying assets, and we manage that very closely and very carefully in terms of industry and exposures. So I think that provides a benefit to investors. The floating rate nature of it means that there's very little capital value impact or capital appreciation, depreciation with the change of interest rates, but it also means that you get your distribution every month. Based on the diversity of products we can write, we can actually offer people liquidity, so we can offer quarterly liquidity, and we're also not solely concentrated on one specific asset or one specific industry. So a lot of private credit funds and a lot of private credit managers at the moment are dedicated on real estate. So that has again provided a lot of benefits when real estate was going up and interest rates were going down, as those two are very highly correlated. But the challenge is in the opposite market, which we're now facing. You've got interest rates going up, you've got property values going down, and you've got a lot of fixed rate investors and fixed rate loans out there in and around the real estate space, whether it be construction, land banking, development finance, those types of things. So what we're able to do is create a portfolio where we've got exposures across short dated instruments such as trade finance, invoice finance, insurance premium finance, but then also mix that with construction finance, land banking, and everything in between. So what that means is we've actually got a really unique mix of liquidity, short-dated exposures, highly secured asset-backed lending, and then illiquid construction loans where you actually get paid a premium that we can pass on to investors, but it's not the sole concentration and the sole risk of the portfolio.
Okay, fantastic. Thank you for your time.
No worries, thanks Sasha.